Hey, welcome back. It's Nolan Mathias from Mortgage 360. And before we get into today's video, I want to answer one of the most widely asked questions on the channel. Is the steam on the coffee real? And yes, it absolutely is. Now, with that mystery solved, let's get into the actual topic of today's video, and that is 7 questions to ask your mortgage broker or bank before you get a mortgage. These are the intelligent and intuitive questions that every person who's going to get a mortgage should ask. But before we get into it, do me that favor, hit that subscribe button, hit that notification button, please hit that like button so more people like you can see this video, and don't forget about our race to 25,000 subscribers, where one lucky subscriber is going to win $5,000 to put towards their mortgage, their TFSA, their RSP, or their RESP. All you have to do to win is click the subscribe button. It's free, it's easy, and it's definitely the definitive guide on how to manage your credit. Product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so let's get into it. Let's discuss these 7 most important questions to ask your mortgage broker or your bank. Full disclosure, I have taken questions that have been provided by different regulators and whatnot, and I've customized them and, in my opinion, made them better so that you know the questions that you should be asking when you go to get your mortgage. So let's get into it and let's discuss the 7 most important questions to ask your mortgage broker or lender, starting with, what type of mortgage is best suited for my needs? So this is a really important question, and this covers basically, should you get fixed or variable, and should you get something like an open mortgage or a closed mortgage? And all of this has to do with what your specific needs are. So for example, if you are flipping a property and you're going to be in and out of it in 2 or 3 months, that type of mortgage is going to be completely different than the type of person who's buying a property to live in for the next 5 to 10 years. So somebody who's flipping a property is going to want an open mortgage, probably a variable with no penalty in order to get out of it. On the other hand, somebody who is purchasing a property to live in for the next 10 to 15 years may want a variable rate mortgage that is closed that has a 3-month interest penalty because they know they're going to pay less for it because it's a variable than they would if it was a fixed rate. They know that the penalty is going to be 3 months interest rate and not an interest rate differential, which we'll get to later on in the video. And they know that their flexibility over the long term is going to be better than if they were going to have a fixed rate. Now, if somebody is totally risk averse, they may want a fixed rate mortgage rather than a variable rate mortgage. And that is just up to each individual and what they feel their risk tolerance is with respect to rising interest rates and fluctuating interest rates. Now, one thing to keep in mind if you are getting a fixed rate mortgage is your mortgage is essentially still an adjustable mortgage. It just adjusts every 5 years instead of whenever the Bank of Canada changes the rates. So keep in mind that a 5-year fixed rate mortgage is a 5-year adjustable, and that the payments and interest rates will adjust in 5 years. And if the interest rates have gone up, then you could feel a payment shock at the end of 5 years, which is why we recommend variable, because the variable rates will increase more gradually and you'll feel that payment increase more gradually over time as a result. So it makes it easier to manage your finances. Now, the second question that we have is, what types of mortgage features and options are best for my needs? So these are things like prepayment privileges. Do I want to have a 15% prepayment privilege with a double up payment option? So a payment that you can double every single payment. Or do I want to have a 20% lump sum prepayment option and no double up option because I want to be able to make a larger prepayment of 20% rather than a smaller prepayment of 15% and more frequent double ups? You may also want things like the ability to skip a payment if you are ahead on your payments, or the ability to draw down any extra payments that you have made in the form of a line of credit. So something like a Scotia Step may be better for you. But this is a really important question because the options are what's going to allow you the flexibility in the future. And if you are the type of borrower who needs more flexibility in the future, let's say you're self-employed or you want to invest in real estate, then you want to make sure you have a mortgage that provides the most options. And if you aren't going to need that flexibility in the future, then maybe a lower rate with a lower option mortgage is better for you. Now, the third question is, how can I minimize the total cost of my mortgage? And by the way, all of these questions, if somebody can't answer these, whether it's a mortgage broker or a bank, go find somebody else. This is a really interesting question though, because there's a whole bunch of ways that you can minimize the total cost of your mortgage. The first and the easiest way is to set it at a shorter amortization. Another way is to take a variable over a fixed, because a variable is typically going to cost a lot less over the long term. The other things that you can do are you can accelerate your payments. So getting a bi-weekly accelerated or a weekly accelerated payment will shorten the amortization of your mortgage and therefore lower the overall cost of the mortgage. So there's all sorts of things that you can do to minimize the total cost of your mortgage over time. And most of those have to do with A, being able to pay the mortgage off faster than originally planned, and B, by being able to have flexibility and make changes to the mortgage over time as things change. So for example, a lot of clients got 2.99 5-year fix a couple of years ago, thought that they were set for rising interest rates and that they were going to be in a really great position. And then lo and behold, the pandemic hits and they find out that they can't change their mortgage to a lower rate variable because they've got a large penalty. So those sorts of things, having the flexibility to adjust your rate and switch to a different mortgage if you so choose, are the types of things that can really save you money over time. What we tell people is anybody can save you 0.1 or 0.2% on your mortgage. That's easy. Brand new brokers come out of the class and they do that. Brand new bankers go through their training and come out on the first day and save people 10 or 20 basis points. What's really difficult is to save tens of thousands of dollars over time. And a lot of that has to do with how much flexibility you have in your mortgage. Now, the fourth question is, what are my options if I cannot make a payment? Now, this largely has to do with the skip a payment option. So some lenders have what's called a skip a payment option, which you can use if you are ahead on your mortgage. And this comes in really, really, really handy if for whatever reason you can't make a mortgage payment at any given time. And this is handy for people who have hourly jobs where their hourly wage may not be guaranteed, self-employed people who may not have a guaranteed wage, and basically anybody who has fluctuating income. So a lot of the times when we have somebody who has fluctuating income, we'll encourage them to take a Scotiabank variable over a First National variable, primarily because that Scotiabank mortgage has the skip a payment option if somebody is making accelerated payments. Number 5 is, what are the penalties to break my mortgage and how are they calculated? This one is really, really important. If your broker or your bank can't show you how this is calculated, now they aren't going to be able to give you the exact numbers for a hypothetical down the road, but if they can't show you how this is calculated and why it is either cheaper or more expensive to do with them, then you probably shouldn't be getting your mortgage from that person. Now, most banks have higher penalties. Their interest rate differentials are higher, and they should be able to show you why their calculation is higher than what it would be at a monoline lender or a lender who specializes in mortgages, a lender like a MCAP or a First National. Now, of course, if you have a variable rate, you don't have to worry about interest rate differentials. But if you're getting a fixed rate mortgage, it's really, really important that one, you see the contract and you see how it's calculated, and two, that the person who's getting you that mortgage can explain exactly how that interest rate differential is going to be calculated. If in the event that you have to pay off your mortgage early, you end up with an interest rate differential. And don't think that this won't happen to you, because 60% of Canadians end up paying off their mortgage early or end up at least making a change within the first 5 years of their term. So be wary of interest rate differentials and payout penalties and understand how they're calculated. There's other videos on this channel that I'll link to up here that explain exactly how this works and why you should not be choosing a big bank for a 5-year fixed mortgage in most cases. Number 6 is, are there any restrictions on this mortgage? So this one is really, really important. A lot of the really low rate mortgages come with what's called a bona fide sale clause or a no refinance clause or a no leave to go to a different lender clause. And what this does is it takes away all of your negotiating power and all of your ability to leave. You pretty much have to ride it out till the end of the term, which means if interest rates go down, you aren't going to be able to get a lower rate by going elsewhere. It also means that if you have a variable rate and you decide you want to lock in, they get to dictate what interest rates you pay because they know that you don't have the ability to leave and go to a different lender. So it's important to know if there are any sorts of restrictions on your mortgage. And a lot of the times you're actually going to have to do research on this and make sure. And by research, I mean Google the lender that you're getting the mortgage from and Google, does X lender have any restrictions on their mortgages, and see if you can find the information yourself, because a lot of the times the bankers and the brokers that are selling the mortgages don't actually realize that the restrictions are there. And of course, always read your commitment letter and your mortgage documents to make sure there's no restrictions in those either that you can find easily yourself. And 7, and the last question is, what fees are involved in setting up, discharging, or renewing my mortgage, and how are they calculated? So first and foremost, when you're dealing with a mortgage broker, we get paid by the lender. Now, some people will argue that if we are getting paid by the lender, that the borrower is actually paying for that. Well, yeah, kind of. But if you can get a lower interest rate and a better mortgage from a broker than you can from a bank, and ultimately at the end of the day, you're paying less, Did you really pay for it, or did the lender pay us to take you to that lender in order to get that mortgage? And I believe firmly that we are a lower cost alternative for the banks and the lenders to actually originate mortgages. And therefore, it isn't actually you that's paying us. It is actually a cheaper alternative for the bank in order to get the mortgage in their door than it is to have a sales force or a branch or all the other things that come along with being a bank. Now, when it comes to discharging your mortgage, there are some lenders that charge things like restocking fees or discharge fees. Some lenders have higher discharge fees than others. And in some cases, if you're getting a private mortgage, you may have to pay a fee to renew your mortgage, even though you were just renewing it. So these are all important things to take into consideration and to know upfront when you're getting your mortgage. And if you can basically go through and ask these 7 questions and get good answers, and you trust the people that you're getting the answers from, then you can pretty much rest assured that you're getting a really great mortgage. But if when asking these questions, you get any sort of hesitancy from the lender or the broker who is answering the questions, then you need to have your spidey senses tingle and start to look further into the details. And if any of these questions don't get answered, or if any of these questions have answers that don't seem like they're the absolute best option out there, then it's probably best to go and get a second opinion. Of course, you can always do that through Mortgage 360. You can also always go through and take our discount or secrets to getting the lowest interest rate course, which I will link to in the description below, with a 50% coupon off the already discounted price. We understand that not everybody can come to Mortgage 360 because maybe they have their own bank, maybe they have their own broker, but part of my why is to inspire people to thrive financially. And that means making sure that as many people can get the information that we provide to Mortgage 360 clients as possible. So this course covers things like how to negotiate with a bank, how to negotiate with a broker, what sorts of things you can negotiate into the contract, what sorts of things you can get reimbursed for, like appraisals and home inspections and so on and so forth. How much margin there is to negotiate in a mortgage, so how much you can foreseeably get off the rate that you are being offered. And it also has a special section on how to negotiate your renewal. We have set up this course and made it so inexpensive that it's accessible to pretty much anybody who is in the market to buy a house. And we suspect that most people will get 10 to 50 times back the cost of the course. So it's really inexpensive. It gives you a lot of information. It arms you with all the info you need in order to get the absolute best rates, but it also describes the landmines and the surprises that come with getting the lowest rate and what you need to avoid. So if you want to join us in that course, I would love to have you. And if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers. We're going to give one lucky subscriber $25,000. I sincerely hope it's you.